Gold was in the news this week. After hitting fresh all-time highs at $2,075 on Friday, we saw a dramatic 10% drop on Tuesday, Wednesday this week, falling back below $2,000 to a low of $1,863. Now, the attraction to gold from global investors has increased this year for several reasons. Gold yields nothing, so as global bond yields fall, the attraction of gold rises. Gold is also seen as a hedge against future inflation. And with the massive central bank stimulus and unprecedented fiscal support, inflationary expectations are rising. If we bring these two views together, then falling real bond yields, or bond yields after subtracting the impact of inflation, have certainly been supportive for the strong gains seen in the gold price in the second quarter. The recent weakness in the US dollar has also been a factor cited for supporting gold. With expectations that this could continue, many have argued that gold should be part of a larger structural investment theme. However, the view that gold is the go-to safe haven in uncertain times took a dent this week. After all, with the US economy falling over the edge of a self-induced fiscal cliff, the US Republican Senate and House Democratic leaders unable to agree on a support package, and Trump being forced to extend pandemic unemployment support through a federal emergency executive order, this is the kind of situation that gold bugs would have expected the yellow metal to outperform. Now, there are probably several reasons for the sharp drop in gold this last week, including the fact that strange things do often happen in global markets in August when liquidity tends to be low due to Northern Hemisphere summer vacations. On top of this, US 10-year bond yields have jumped sharply higher as the record quarterly refunding hit prices. 10-year yields jumped from just above 50 basis points late last week to a high of 0.725% last night. The US Treasury this week sold a record $112 billion of coupons at its quarterly refunding package this week. Over the 3 months through October, it will issue $947 billion of US Treasuries, which is $132 billion more than they issued last quarter, with around half of this being new money. Finally, the US dollar has bounced slightly this last week on better US employment data. Employment rose by 1.76 million in July after June's 4.79 million surge, and the unemployment rate slipped from 11.1 to 10.2. Of course, the US labor market remains weak, with payrolls still 12.9 million below February and the U6 or underemployment rate at 16.5%. But the news was much better than economists forecast, helping the US dollar to rise and gold to fall. We also had good employment data here in Australia in July this week too. Total employment surged a further 115,000 in July, a solid gain following on from the robust 252,000 bounce in June, which was revised up from 211,000. Despite the much better than expected jump in employment, the unemployment rate lifted to 7.5 from 7.4%, and the total number of unemployment rose above 1 million for the first time ever. That's 313,000 above the number of unemployed people at the end of last year. As the ABS noted, the July data captured the move to stage 3 restrictions in Victoria, but the August labour force data will provide the first indication of the impact of stage 4 restrictions. And if the Westpac Melbourne Institute Consumer Sentiment Index is anything to go by, the impact could be noticeable. Indeed, Westpac's chief economist Bill Evans noted the biggest surprise in consumer sentiment for August was in New South Wales, where sentiment collapsed by 15.5%, well in excess of the 8.3% fall in Victoria. Remarkably, the index in New South Wales has reached 77.8, below Victoria's read of 78. Concerned that the impact of a second wave of cases in Victoria and New South Wales might extend the recovery process seemed to be in the RBA Governor Lowe's mind Friday when he testified at the House of Representatives Standing Committee on Economics, warning that we should be prepared for a recovery that is uneven and bumpy. The recovery is also likely to be more drawn out than was initially expected, despite the downturn being less severe than we expected. Now, the Australian dollar has remained in a tight range below 0.72 after numerous attempts last week to break above that level. There are no major data releases due next week in Australia, though we do have the minutes from the recent RBA meeting on Tuesday. We're also due the minutes from the FOMC meeting on Wednesday, and now that presidential candidate Joe Biden has chosen his running mate in Kamala Harris, expect to see a lot more of the pair at the Democratic Convention, which starts Monday in Wisconsin and extends through to Thursday. The note, this convention will be very different from others, with much of it being virtual. These are all factors we'll talk about in next week's Market Update.